Welcome to the Millennial Money Moves podcast, the podcast where we're breaking down the financial stuff that actually matters to your real life. In today's episode, we're diving into the world of mortgages. Maybe you're considering purchasing a home for the first time. Maybe you just bought a home and you're wondering, when will I ever get to refinance this thing? Or maybe you're just thinking about it and you're curious, what's it going to take to achieve my dream home? What kind of down payment? What are interest rates doing? This episode's for you. Blake and I are sitting down with seasoned mortgage professional Jamie Fernandez, who has been helping his clients navigate the homeownership process for years. A lot of good tidbits in this one. We appreciate you for listening. This content is purely educational and is not intended to be financial advice or financial planning. Please consult your professional financial advisor or tax professional to receive tailored advice to your personal situation. Babin Wealth Management is not responsible for action taken by listeners based on educational content provided. If you would like to receive personal financial advice, please reach out to Babin Wealth Management directly at babinwealth.com. Let's make moves. Welcome, everybody, to another episode of the Millennial Money Moves podcast. I'm your host, Sean Babin. We got our goose, Blake Bandani, back at it again with your boy. Good to see you, man. How you been?
You already know, the one and only, baby. Good to see you.
The one and only.
The one and only.
Yeah, man. Good to see you again. Good to be back in the recording webs here. We have a very special guest for our listeners today. We got Jamie Fernandez, who is a mortgage broker, entrepreneur, serial hustler. So grateful to have you on, man. I really thought this would be an awesome conversation for us to just get to know you a little bit better. And then let's talk about what the heck is going on in the mortgage world right now. Like, I feel like a lot of our generation that doesn't own a home wants to own a home. And it feels like a daunting mountain to climb. I love the gifts where it's like, I should have bought a home when I was 5. I should have invested when I was 5. Like that's what's going on right now. And I think a lot of our generation just feels kind of at loss when they see what interest rates are and how expensive things have gotten since COVID. So love to dive into that and and then some money moves from you, brother. So thanks for being here. Good to have you on.
Cool. No, it's a huge honor to be on the podcast. You guys are killing it. I see it.
Appreciate you.
Ever since it first came out, I've been watching religiously.
What a guy.
So I'm on those money moves, you guys,
Let's go.
Yeah, iron sharpens iron. I think that's probably the biggest thing that has helped me out in my career. Being a mortgage broker it's been a blessing in itself. And it's funny because I kind of fell into that world is how it worked out for me. So just to kind of give you a little background on me, I've been in the finance industry now for coming on 12 years, on my 13th year now. And it's been awesome. I started with the banks. And it's crazy. I started with JP Chase. That was like my first job ever. And I remember when I was working there, I used to see the financial advisors and I'd be like, dang, like, I see how they be moving it. They got a sharp suit on. I was like, man, I got to strive for that. I used to I was a no-name teller, man. And I was just trying to figure it out.
You got to start somewhere, Slim.
100%. And that's really where I really started to grind for it. I said, hey, I remember telling the manager, I was like, hey, I want to be in that guy's shoes over there. And I pointed at Mr. Pretty guy, in the
wingtips.
Man, 3-piece suit, the guy looks sharp. And I used to be like, wow, what a power move. And I really dedicated my life to banking. In that short time, I was 18 years old when I started with the bank. And I just didn't look back. Every year I progressed and I got into a new position every year. With JP Morgan back in the day, they used to have a rule. You had to be in your role for at least 1 year before they can give you a promotion. And so finally got to the point where they gave me the opportunity to take my investment licensing. I jumped on it. I got my Series 6, my 63. I applied for my SIE. I thought I was like 21 too at the time. So I thought the world was behind, the world's is mine. I can do whatever.
The world is your oyster, baby.
Oh yes.
You can sell mutual funds now. Let's get it.
I felt like I was up there, and then I made a healthy transition over to this credit union, working for JP Morgan for a while. In the investment world and just consumer banking. And that was cool. And then moving over to the credit union, that's where I got a lot more dangerous, I'd actually say. That's where I really started to learn how credit works, how you can really understand someone's finances. The credit union had different programs, a little bit more hands-on than a retail bank, like these big box office brand names that you know of, like Chase or Wells Fargo or Bank of America, just to name a few. And working at the credit union was so cool. I learned so much about the process, how credit is actually used and how you can actually use it to your advantage and get you in a better position financially. I learned a lot about debt consolidation and then going into getting out of the credit union, I ended up kind of joining the ranks a little bit in the retirement 401k sales world. And that was fun. I loved it. I loved
Shout out
it.
Mass Mutual,
Shout
Phoenix.
out Mass. Yeah, Mass Mutual was an amazing company to work with. I really got to spread my wings. I really got to rub shoulders with some big names. Definitely some big names. There were some big hitters in that industry. And that just gave me more confidence. I think that was the biggest thing is in this world, in this realm that we're in. Confidence is key, and then you got to back it up. So, you can talk the talk, but you got to walk it too, and that's where I really got to learn hands-on. The confidence piece for me, I think, exploded during those years.
Well,
And
real quick, Jamie, fun story, fun fact.
Yeah.
I had moved from the East Coast to the Phoenix office for Mass Mutual. That's where I met Jamie. And I still had East Coast coverage in Phoenix. So I was coming in at like 5:36 in the morning to stay on time on the East Coast. Jamie joins the team, and I've never seen anyone hungrier. And I kid you not, I think what you said, Sean, serial hustler is what should be your name tag, Jamie.
It's
like after going through training, which I don't know, what, a couple weeks, a month, Jamie's like, hey, I want to join you. I want to sit on your calls. And this guy would come in the office at like 5:36 in the morning, sit next to me, tag along on my phone calls. I was like, this guy's going to do it, man. He's going to make it. So just had to give you that shout out, Jamie.
I appreciate it, man. And kudos to you too, Blake. I mean, it was huge, man. I definitely came in with that Mamba mentality.
I love it.
Everywhere I go, I'm like, okay, who's first, and get ready to play for second because I'm coming. That's the type of mentality I always had. And it's funny because coming into it, understanding how finance worked, I was really able to incorporate it with my real estate portfolio. And when I got to Mass Mutual, I felt like I was at a height of my career, but then coming into Mass, I was like bottom of that list. I was like, dang, like I was like a good size fit. I think I outgrew my pond that I was in. And so going over to Mass Mutual, I found out I was little fish in the pond. And seeing somebody like Blake, I mean, that guy, talk about killers, man, that's one of them for sure. Like I said, iron sharpens iron, real recognized real, whatever the saying is. I knew, I was like, that's the guy right there. I was like, that's the top guy. And so I really wanted to learn from him. My shift didn't start until 9, but I didn't care. I wanted to get there early. I used to hear him in on calls. I used to pick his brain, and definitely made a better man out of me doing that. So
and then I would leave around 2, and Jamie would stay till 5. So I was like, man, you might surpass me quicker than I thought.
I definitely put in that work, and I really couldn't have done it without you, man. And it was a lot of help. Yeah, it definitely was super influential to my career. And then Mass, whether the viewers know or not, Mass Mutual went through a buyout. They got bought out by Empower, and when they did, I remember the sales director there was like, "We're not getting sold. We're fine. don't listen to the Reuters articles and all of us. We're doing Teams calls in the background, like, oh, I think we might be getting sold here. He's selling this a little too hard." And to be on the up and up, that's when I decided to say, you know what, I really love financial consulting. I feel like I'm in a spot in my career where I had just the best of everything. I was definitely a Swiss Army knife in my career at that time. I knew a lot about investments. I knew a lot about financial debt consolidations, putting yourself in a better position financially. I've said, hey, you know what? I think being an independent mortgage broker would probably be a good spot. So I got my license in 2021, or I'm sorry, I'm lying to you. In 2020, I got my license. I jumped on with an independent mortgage company. It was really solid. I loved working with them, and the dream really began from there. I really started pushing hard. Applying myself, reaching out to people, hitting up my current sphere, my SOI, my sphere of influence, people that I knew that knew me and said, hey, Jamie's now an independent mortgage broker. How can I help you out? How can I get you guys going? And man, you'd be surprised. 2021 was such a great year. And then 2022 with mortgage rates really took a huge uptick. And when I say uptick, I mean, we're talking, I remember a client, I had them approved at 3.99 back in 2022. And this was in March, and beginning of March, and look it up. You can Google this info, and it really did happen. It was a huge jump. I would say by April, that same client would have gotten 4.5. Oof. And a couple months later, it was turning into 5.5, 6.5, and then 7.5. And then we were going all the way up to I was seeing clients getting approved at around 8 or 9% interest rate.
Wow. And that's scary as a buyer, right, Jamie? Like, I think that's to Sean's point, like, and that's why it's such a good timing to have you on here, is a lot of those clients probably never bought a house before either. So they don't know what to expect, right?
It's crazy. I bought my first house in 2013. That's when I bought my first house. And when I purchased it, my interest rate at the time, I was 20 years old when I bought that house. And 19, just turned 20. And I remember when I bought it, 4.25, and people were, and at that time, the rates were actually a little bit lower than that. I remember people were telling me, Jamie, you're getting hosed, you're getting robbed, this interest rate's super high. And I remember at the time, I was like, honestly, you guys, it's all perspective. I was like, 4.25 to me sounds like it's doable. I was more focused on, I knew better because I was more focused on what I could afford. I lived within my means. I said, hey, yeah, the rate's 4.25. You guys are getting approved at 3.5 or 3, but my mortgage payment was $600 a month. So at the time, I bought a 2-bed, 2-bath townhouse, and I was like, I can manage these payments. It's not a problem.
Jamie, I might kill someone for a $600 mortgage right now, to be honest.
It's crazy because I still have that payment today. I still have that mortgage payment to this day. I still have that home. I always kept it. Interest rates fixed. People are like, oh, why didn't you ever refinance, in 2021? I had the opportunity. I told myself, you know what, I'll leave that money in there. I'd rather just have that sucker paid down.
Well, I think also you hit a key word or key phrase, living within my means. And I think that's probably a dream client for Sean, is someone that can recognize budgeting and not living outside of those means, right? And I think that's just so impressive. And it's probably tracks back to just being in that industry so early on in the bank and stuff like that, huh?
Yeah, and I'll even throw in a millennial move early in this call, and that's definitely it.
Let's do it.
Let's live within your mean, folks. If you're listening to me right now, you hear the words that are coming out of my mouth. Yes, live within your means. I'll tell you what I've learned from being around the block here with these loan officers is different. A lot of loan officers will tell you, hey, you're qualified all the way up to $1 million, $2 million purchase. Doesn't mean you're going to go out there and go get $1 million, $2 million home. I always tell my clients, hey, what are you comfortable with paying monthly? Let's start with that. If you can't handle a monthly payment in the $3,000-$4,000 range, then why are you looking for houses in that price point? It doesn't make sense. Yeah, you can qualify on paper, but then IRL, right? In the real world, how are you actually going to, in real life, how are you actually going to make it happen? How are you going to survive out there? That payment's killer. And so I always try to put that in perspective for my clients when I talk to them now, as they go, hey, what's something that's within your budget? And then once they tell us, and it's usually reasonable, most times when clients come to me, I'll tell you it's a 90-10 split. 90% have already been looking at Zillow. They've been looking at those $1 million homes we all know we can't afford. I've been looking.
A kid can dream, Jamie. A kid can dream.
Hey, and I be dreaming. And I look at that and I go, oh, wow, these houses are so cool. I play around with that little mortgage calculator that's on that Zillow app, and I get a good idea. So I would say 90% of my clientele that come to me already come saying, Jamie, I have an idea of what I want to get. And then the other 10% are clients that are just really brand new. They're green as the grass grows. Someone put an idea in their head to say, hey, let's go buy a house. And they said, okay, let's do it, but I don't know where to start. And so I really tailor every client is like a snowflake. You're unique. You really got to tailor them down. You got to adjust to their speed and their level and their personality. So how it's very similar to, in the financial advisor world too. You really you have so many different personalities of people you got to work with in different walks of life. And so you definitely have patience is a virtue in this game for sure.
Yeah, man. Well said. And I think it's so interesting because buying a home, you do have to start with that monthly payment, and you got to be upfront about like what you can afford right now. It's the complete opposite when you go buy a car. You never tell those people what you can afford, because they'll just stretch that 5-year loan to 10 years and get your ass.
Oh, you
in
want that? We can make it happen.
Car. Yeah. Anyways, but yeah, man, I think let's just start there a little bit. Like, I love that that's your bread and butter. One of the reasons I wanted to have you on here, like getting some green first-time home buyers into a house. Like, the American dream is owning a house, and that used to be, and kind of still is, like the gateway to the upper middle class. And it just feels like, and since COVID, like if you didn't buy a house in 2020, 2021, you're kind of like, it's very difficult unless you're making a lot of money or get some kind of inheritance to buy a house with a $2,000 or $3,000 a month mortgage. So walk me through like what you're seeing out there and kind of how you go about working with kind of these first time home buyers, and what are maybe some pitfalls and traps and just some things that some of the listeners can easily take away from it.
I think some of the biggest key takeaways, if you're listening right now and you've never purchased a home right now, you don't know where to start, and you want to get in there, it's really just having the conversation. I think that's the first step, is just it's almost like having a map in front of you. You got to find out where you're at first. You got to find out where do you stand. And what I actually do for my clients is most loan officers like to jump right into bed and pull credit. They want to just jump in there. Let's pull credit. Let's see what's going on. A credit pull dings you 7 points on average on a hard pull. So fun fact to know. I work a little old school, and I tell all my clients I work old school. I like to look at your income first. Let's talk about your debts. I have the mental aptitude to say, hey, I can kind of figure out where you're at. I have a good idea. You can, when you've been in the industry for so long running numbers, you hear it, and if it doesn't sound right, it doesn't sound right. And so from my point of view, I really try to I put myself in the driver's seat. I got my clients in the back seat, and I'm telling them, hey, buckle up. These are the rules of the road. These are things that you need to understand. It really is just having that first initial conversation of, okay, this is how a mortgage works. Most people, I'm at the busiest. I'll be honest, I'm at the busiest point in my career right now. I've never been busier, which is such a blessing.
Congrats.
Thank you. I remember in 2022 when rates were just at all time highs. I remember just telling my wife, like, wow, how am I going to do this? I don't know if I'm going to be here much longer. I was like, it's slim pickings. I remember I was scraping the bottom of the barrel. I was pressing. I was trying to make a dollar out of a nickel. I really was back then. And it's crazy to see the growth in just these last 3 years. Have just been exponential, literally 2, if not 3x from the year before. And it really just started blowing up once we started seeing more and more growth with the market. 2023 was kind of a weird year. 2024 started to pull back a little bit. And that's when we started seeing a huge growth. That's when the 3X came in, was last year. And then this year, we're on track to about double what we did last year. And most of our clientele, it's such a healthy spread that I have that I'm working with right now. So for example, it's anywhere between FHA, which is the Federal Housing Administration. Those are government type loans to help first time home buyers. It gives them an incentive. You'll often hear the term when people say, oh, I'm a first-time home buyer, so I get first-time home buyer benefits, right? And it's true, but to a certain degree, there is some devil in the details with that. Your next level up from an FHA loan would be your conventional loan, which also still offers first-time home buyer programs. It just offers you better incentives. So that means that you can put a little bit less money down to buy the home. Not always the best option. If you do have a little bit more money to put in, that's kind of where somebody like myself would tell you, hey, this is the way I would structure your loan so you can have the best of both worlds, have the payment that you want and have something affordable in your day-to-day for you and your family. And then,
well, I was just saying, Jamie, let's unpack that too. So
yeah.
I don't know. I think if I'm giving you my personal opinion, it's always felt like you should have a little bit of a nest egg when you're ready to buy. But then kind of just hearing you in the last 15 or so minutes, am I wrong to say that maybe you don't necessarily need a huge lump sum when you're ready to buy? Like if you are pretty tight with your budget and you can do you really need $100,000 in a cash account to start looking, or do you need 20 grand? Do you just need to cover that up front? Like what do you typically see, or what do you recommend to clients if they come in, you're looking at income, and you're like, maybe you should wait a little bit, start saving, or like, is there and maybe there's not, but is there like a golden time where you should say, hey, I'm ready to start looking. I feel pretty secure?
Yeah, it's a great question. I think pro tip would be that's also falling along the lines of living within your means. So when we look at your income, we compare your income on a month-to-month basis compared to your monthly debts that you're paying on a month-to-month. The monthly minimums, not the extra amount that you put in over the minimum. Right? It's the monthly minimum. So if you have, for example, like a very expensive car payment, we got to talk about it. We got to talk about how we can get you, restructured. Because at the end of the day, if you have too much debt and you don't have enough income, it's actually going to be represented in the form of a percentage. And if that percentage is too high, the bank won't approve you.
Is that the DTI, debt to income? Do I got it?
That's the DTI. Nailed it, man. It's certified NMLS. On your way, man.
But no, so to your point, if your DTI comes out pretty high, that's more of the golden rule. Like, let's get this down before we worry about a cash account, or let's get the DTI number down. And then, does that ultimately allow you to get approved for better rates, of course, or not necessarily?
Yeah, it does actually. Great question. Okay. So the lower your DTI is, the more conservative your file is going to look to the bank, and the bank's going to give you better. It's crazy. When you are at the end of your rope, the bank charges you the most.
Crazy.
They almost decentivize you to want to buy a home. But when you have great credentials, you have a great credit score, you have great financials, the bank's more incentivized to give you better deals, better offers. They actually help you out more on your mortgage. So really cool pro tip on that end is the lower your debt to income is. So for example, let's say in the world of finance, FHA can go up to 56%. I don't recommend it. That means for every dollar in income,
break that down.
Yeah, every dollar of income you make, 56 cents pays your debts, your monthly minimums. And so I really like to have my clients under 50. And honestly, if you're asking me, I'd love for you to be under 45, under 45%. I think under 45% debt to income is a very healthy range. A lot of people qualify with 45% debt to income and still have leftover, that remaining amount per dollar that you can apply towards your monthly minimums, your method of your style of living. If you have a certain way that you're accustomed to living, those things are all going to play a part in that equation.
And then I've also heard before, like, I think you touched on it, but like a first-time home purchase versus a conventional purchase, right? Break it down. Like, I'm sure people that maybe hopefully they go through you, but they're talking to someone like, and maybe everyone maybe you ask 10 mortgage brokers and 10 have different answers. But in your opinion, like, do you do the first-time home purchase route? if you have the means, do you go conventional if you can cover it? Like, what do you think on that note?
So the biggest thing, and it's a great question, and it always feels a little loaded because I might unpack a little bit here, but I'm
Sure,
going to try my best to kind of stay on the straight and narrow on this topic.
please.
So with FHA, what's cool with when the people say first time home buyer program, it's usually just a hook, just to get you involved, just so you can tell people and brag and say you have a first time home buyer program on your home. FHA minimum down payment is 3.5% when you're buying a home. And the reason why a lot of people would go FHA versus conventional sometimes when you're buying a home is if your income's a little bit on the lower side, debt to income's a little bit higher. FHA loans are a lot more forgiving. So they're a lot more forgiving. So it's for somebody that's not a perfect star, but they want to buy a home and they really want to do it. And they said, hey, I have another partner, but my partner isn't all the way, with their income. So I'm not going to have them on the loan. But I know that once I get this home, we'll be fine. As long as that individual can qualify on their own, we can get them a mortgage and they have a plan. We'll go for it full steam ahead. Another thing to also keep in mind as well is with FHA, you also have access to lower interest rates. So FHA always think 3.5% down, lower interest rates, and they have a little bit more lax guidelines for approving people.
Yeah, why would I ever not do it if you're allowed to do one? Why would I not do it? I mean, where does conventional come into play?
So conventional comes in because you can put a little bit less down. Some people say, hey, Jamie, I want to get into a house. You can get into if you're a first time home buyer on a conventional loan product, you can get in it with as low as 3% down. So it saves you stuff by 0.5%. There is mortgage insurance you have to keep in mind too, the mortgage insurance, and the interest rates are a little bit higher on conventional. But if the condition of the home, let's say, has a couple things that would cause a problem on an FHA, because FHA is government guidelines. So if an appraiser goes out there, for example, an appraiser is somebody that's going to tell you what the value of the home is. If somebody goes out there and they see some things that are actually violating an FHA guideline, you can't even go FHA.
Got it.
So that's why some people will actually, and I'm actually going through that right now with a client where there's so many repairs. The excess is over $5,000. If the property has an excess of over $5,000 in repairs, the appraiser might just say, hey, you know what? And the seller doesn't want to pay it. We might just have to switch this over to conventional, where conventional has a lot more relaxed guidelines on actually the power of the home to be habitable. So if the home is habitable, meaning you can live in it, it's not the prettiest house on the block, but it does have some things that FHA would hold you up on. You can switch it to conventional and still get you approved and still get you in the home. A little bit less of a down payment. There's trade-offs, higher interest rate, not that much more crazier, but it is something to consider. And if someone's going to put 20% down, last thought on this one is whether you go FHA or conventional, if you put 20% down and you go FHA, you're still going to pay mortgage insurance for the life of the loan when it's FHA because it's government backed. If you go conventional, since you're going through private banks with a conventional loan and you're putting 20% down, mortgage insurance is no longer charged to the loan. So you essentially you can save yourself $100 to $200 a month just in that mortgage insurance piece. So it's got its trade-offs.
Got it.
Is there a dollar threshold on FHA loans? Like, will they go into the jumbo range? Could you be like, hey, I want to buy $1 million home as a first-time home buyer?
Great question. So FHA definitely has its limits, and even conventional has its limits too.
Okay.
So for example, FHA, we're looking at about 530,000 roughly is the FHA Maricopa County limit. Now, every county is different depending on what state you're in too. So if we have listeners in other states, easy way of checking it and finding out is just typing in, you can go to Google, type in FHA county loan limit and put in the county that you're living in, and it'll tell you what that limit is. Every state's different, just depending where you're at, whether in California, Florida, those numbers can change for sure. Texas, Arizona, though, it's 530,000. So anything that you find as a home, as long as your loan amount is 530,000 or less, and there's a little bit extra to that 530, but we'll just, for the sake of the conversation, easy numbers, 530 or less, you can use an FHA loan for those type of products. So what's great about that, and one last touch on FHA, is you can also use down payment assistance programs, and you can actually apply down payment assistance for an FHA home purchase of up to that $530,000 limit. So for example, I had a client last year we helped out with, we did an FHA down payment assistance program. How those programs work is that the local housing authority or some local authority will give you a grant, or it can be a loan, depending on who you talk to. So make sure you reach out to me. I can get you set up. But basically how it works is that you'll get a grant or a loan in the amount of whatever the minimum down payment is, which is 3.5%. And then the buyer is responsible for their own closing costs. Now, if you can get the seller to give you some credits, those are incentives for them to buy your home, you can cover those closing costs completely. So in reality, you can get into a home with under $1,000 all day long. As long as you can get seller credits to cover your closing costs, and if you can have a down payment assistance program where the local authority is going to cover your down payment, it's a home run. That's how a lot of people can do it. So a client of mine, now the only trade-off to doing a down payment assistance program is the interest rate is higher. And it is higher than a conventional loan. We're talking about rates in the sevens, high sevens, low eights is what you're going to be looking like. But if you're buying a $400,000 home at 3.5%, you're saving yourself quite a bit of money, north of $14,000, $15,000, just depending on just in down payment alone that you don't have to pay. And if you do a grant program, it's completely forgivable. You don't have to pay it. You don't have to pay it back. It's free money because it's a grant. Now, some people will often opt in for a loan on that down payment, and it comes in the form of a second mortgage. It's a second payment that you have to do. You make your mortgage payment like you normally do. You have your second payment. The reason why someone would get a loan is because the interest rate would be a little lower too. So you really get to pick your poison as far as where you want to go when you're buying a home. If you want the government to pay it, it's going to come at the most expensive cost. Get a loan, it's a little bit less. If you pay it out of your own pocket, you're guaranteed to get the lowest interest rate possible.
If you go through where you have to cover and include mortgage insurance, which did that come out because of the whole market crash, or has that always been a thing? I don't even know.
That's a great question. I know with mortgage insurance, it's really just a protection that the bank puts. It's a
bank wants
that the bank puts. Yeah. And I think that, correct me if I'm wrong.
Might have been around
here. Yeah, it's been around for a while. I know that.
But it definitely got high-end after the market crash, I bet, where banks were losing. But when is that for the life of the loan you pay mortgage insurance, or is it does it get cut off?
So it just depends on what type of loan you get. So if you have an FHA loan, you're going to pay mortgage insurance for the life of the loan. Whether you like it or not, you just got to pay it. What most people do is they'll get into an FHA loan, and then when you have enough equity, and that equity amount is if you have at least 20% of equity in your home, you can always switch it over to conventional, and you can drop off that MIP is what we call it, mortgage insurance.
Mortgage insurance.
For FHA loans, they call them mortgage insurance premium or mortgage insurance for short. But when you go conventional, if you have less than 20% equity in your home, you have to pay mortgage insurance. Or when you do a conventional loan, you'll notice it'll tell you from years 1 through 12 or 1 through 10, it'll tell you your payment's going to have a mortgage insurance, and then years 12 and on, or years 11 and on, you're not going to have mortgage insurance. The idea is that when you get to a certain point on a conventional loan, if you have 20% equity, and this is free game for anybody listening right now, but if you're sitting right now at home and you're listening to this and you have a conventional mortgage and you have more than 20% equity in your home, you can actually call the servicer. You pay a small fee to have an appraiser come out. The appraiser comes out and says, hey, your home's worth this much. And compared to what you actually owe on the home, if you have that 20% equity, they actually will remove that PMI off of your conventional loan, which is such a sweet hack.
Yeah, they're not going to call you and let you know that you've hit 20% equity.
Oh no.
So you can pay that for the rest of your life if you don't take any action.
Crazy.
So that's some free game that I'm so surprised how many people don't know that. And I always try my hardest to tell my clients, especially when we go conventional, hey, once you have 20% equity, or we start seeing market corrections where we start seeing rates coming down, values of homes usually go up. I always tell them, think of it like a teeter-totter. When you see home prices go up, chances are interest rates are going down, and vice versa. It's definitely a good time to say, hey, when you think that, and you can always call me and ask, and I'm more than happy to just jump on and say, yeah, no, hey, you know what? You're ready for this. Call your servicer, or you can always refinance it if you're in an FHA loan and you want to get rid of that mortgage insurance premium. That's where we can definitely put some damage on that loan.
So I think today's day and age, Blake kind of started this whole conversation off with, it was the idea of that you need a bunch of money down payment to buy a home. I think now it's just kind of the conundrum is you need that kind of money to make an affordable monthly payment for the homes that cost, it all depends on your market and your areas, but starter homes up here in the North Phoenix, North Scottsdale area are $750, maybe $650.
Crazy.
And so, one, those are beyond the FHA limit to just put pretty much nothing down. So you got to come up with something. So long-winded question here, but have you seen it pick up in co-buying agreements, people that maybe aren't married, but college roommates or something, buying homes together to try and make that more affordable to them just to get into the real estate game?
Oh, absolutely. And I would almost, definitely have it down in writing. Always have a contract. You can definitely get yourself into some weird situations.
For sure.
But I would say
we shook hands, Jamie.
What's that?
Well, we shook hands. You promised that half of it was mine.
Where's bond, right? Yeah, no, I would say, I think that's a great idea. If you're listening right now and you have a buddy or two that you guys say, hey, let's pull some money together, let's buy a house. Once it goes over that $530,000 loan limit, then you go into the conventional side of it. And then even conventional has a limit. And once it goes over that limit, then it goes into a whole nother realm. And we're talking jumbo loans. And those are high cost, high value loans. With that though, going back on topic with that idea, I have been seeing quite a few people that they'll get qualified on their own. They don't like what they're qualified for. And so that's when you'll hear a loan officer say, hey, let's get another applicant on the line. Let's get somebody else to join on with you.
Like a cosigner kind of thing.
Bang, there it is. So it'd be exactly like that. It's kind of like the car dealerships, right? Where they're like, hey, we got you here for this loan at a 360-month deal. We're trying to get you qualified. We need, can we get mom on? Can we get, someone you trust? I would tell you, if you're going to do a mortgage, get someone you trust completely. It's somebody that you trust, have some type of understanding, write it down, maybe have a nice mutual agreement of like, hey, if we were to sell this property in the future, we could split the profits 50-50 after the loan's paid off, or whatever split you and your friend decide to do. But I have been seeing that more and more people have been getting on, just because interest rates are still high. Yeah. Interest rates are still high compared to where they were back then, right? And so that's the biggest thing.
It's interest rates are high, home values are high, and they haven't budged not a lot since the tick up in interest rates. And I think that's the conundrum that, most people who aren't home buyers sit in right now. It's like, that $700,000 home that has now become, for whatever reason, in certain areas of the country, a starter home. What is that? You tell me, but I'm throwing out numbers here, like $5,000 a month, if you're putting a certain amount down, 10%, 20% down.
So I'll tell you, it's a very wide range, because it's just, every person is so different. Their financials are so different as well. And one thing that I will say so there's this report that goes out every month. Her name's Tina Tambor. She comes out with this report called the Cromford Report. And in the Cromford Report, she actually talks about market analysis. She sees how, just specifically for Arizona, for the Arizona market. And she talks about how the values of homes, how they've been and how they've swung. The last report that she had was actually a couple weeks ago. And she was talking about how expecting prices of homes to have a correction of 5%. So for what it's worth, I'm not telling you that that's going to happen, or that it's written in stone and that's, start buying houses now. And it's not to generate more activity, but it's just the truth that you're probably going to start seeing houses take a little bit of a downtick on pricing of homes. And it's just mainly because of the tariff situation. I think that's probably what everybody's all freaking out about. The market makers, when you see people in Congress saying certain things, and then you have the Federal Reserve with Jerome Powell not making changes to the interest rates, that's going to affect us. That's definitely going to affect, because the Federal Reserve really does have a say on, are we going to cut interest rates down, create more economic easing into the economy, or are we going to have to tighten up, and put it in a position where people are not going to be as so quick to want to buy.
And I think that dance is when the economy is forever kind of walking. And it's crazy that there was that like opportunity or that moment in time where rates were like 0% and mortgage rates were 2.2 for 15 years and 2.9. And
should have bought.
I try and tell all my clients too, like, it's just like trying to time the stock market. It's like, don't wait for that moment. Like, I have no idea. No one has any idea if rates ever go down that low, but that was always the thing in 2021 and 2022. It's like, oh, I'll just wait for them to come back. I'll wait for them to come back. It's working with a professional like yourself, Jamie. Like, if homeownership is your dream and what you wanted to get into, there are ways to make it work. Now, is it going to be, like you said, that $800 million home that you see on Zillow that your wife sends you every week of, hey, look at this one I found and the price is 1.4 million? No, it's probably not going to be that house. But if it's a realistic goal for you, like, you can still do it. It's just, again, like you said at the jump, living within your means. And that is the hardest thing for any of us to do, especially as we start making more money. We do that spending creep, and it's just, we want more, we're making more, we want to reward ourselves more. And that is the capitalistic environment that we're in. And just, we as kind of humans, we want more, need more, bigger, better, badder. So yeah, man, I appreciate you sharing that, because that was, the dream's not dead. That's what I really wanted you to have you on here. Yeah. It's like, the American dream is alive and well. Homeownership, has it gotten harder? Absolutely. Are you going to get into that luxury home, or is your first home going to look like you thought it was? Probably not. Is it going to cost what you thought it was? Probably not.
No.
But it's still a possibility for you. And there's a lot of creative ways that working with someone like yourself, not a Quicken or, 1-800 Chase Bank, working with an individual that can really get to know you and your finances and craft a game plan for you, I think is the huge value add for working with the independent broker like you.
And I do want to share one really cool win. And
Yes.
this one's always stuck with me. And I'm not gonna lie, man, it makes grown men cry. I think it's something. It's pretty cool. I remember I had a client. He had an ITIN. So an ITIN is somebody that has it's a identification taxpayer number that you have when you don't have a social. So that means that you have either a permanent resident status to be here in the United States. And this all happened actually in 2022, and when rates were at an all-time high. And I remember this borrower came to me, and he told me a situation. He had three children, all young. Him and his wife were living in a 2-bedroom apartment. Him and his wife slept in one room. He had all 3 kids in the other, crammed in there. And it's an apartment, so it can't be a huge room, right? I remember him telling me, man, I really want to have each room for my kids. That's what I want to have. I want them to each have their own identity. And as a father myself, I have one with another one on the way. At the time, my daughter was going to be born that year. And I remember just, it hit me. I was like, wow, it's crazy. He got declined by 3 other lenders, and the main reason for it is because it just wasn't traditional financing. He couldn't qualify for a traditional home mortgage. And this is for somebody that can't qualify FHA or conventional. There's actually another realm, and it's called non-QM. It's non-qualifying mortgages. So it's a whole nother realm of financing. And it's not just for people that have ITINs. It's actually people that are also business owners. If you're a business owner and you write a lot off on your tax returns and you can't qualify with your tax returns normally, there's bank statement loan products that we can use. So basically how that works, we use the last 12 months of your bank statements, and we use those deposits as your income. We don't even look at your tax returns at all. And I remember telling my client, hey, let's make something happen. It's going to be a little more expensive because non-QM is one of the most expensive loans out there. I'm not going to lie to you. I'm going to be as upfront as possible. Those are going to be one of your most high cost loans. But with that process, we got him approved for a home out in Phoenix. So 4-bedroom home with a big old backyard. Wasn't in the prettiest condition. This borrower was in the construction industry. He invited me last year for a cookout. He goes, Jamie, I wanted you to come over and check out the house. And I was like, oh man, I've been waiting for the call. I was waiting for you to tell me that. I came by. I got invited to the carne asada, as they say.
Oh, yeah.
And I got some carne asada with the fam. And it was so cool to see how much addition, how much change he's done. The house is not even recognizable. I pulled up and I was like, wow, he painted the whole outside, painted the whole inside, new flooring. Each room is customized to the kids. It made me cry. I'm not gonna lie. I remember getting back in my car and being like, dang, I made a huge impact in that person's life, and that was somebody that was crammed, 3 kids crammed in a room to now each kid has their own room, seeing them running around, smiling, in the backyard. It's nostalgia, man. It's like, wow, this is why I do what I do. I'm so blessed. I'm so blessed to be in a position where I can really make a change in people's lives, and we really do make a difference. And so I take my job super seriously, my career, I take it super seriously. And then that was a huge eye-opening moment for me, seeing how happy he was. And I just remember getting in the car. My wife's like, you just finished smelling onions or what? And I go,
Well, to Sean's point, the American dream's not dead, right? And you made it happen, man. That's awesome.
Yeah, man.
It was really cool to see that.
You have the ultimate job, man. You're putting roofs over people's heads. That's awesome and very heartfelt and comforting. And especially when you can take what might have not have been a good situation or maybe not have worked out for that guy into something changing the stars and putting him in a house. That's insane. That is an awesome win, man.
Yeah, definitely. No, that one's always going to stay with me in the books. I'll always think of that guy and that fan. It was probably the first time I've seen so much happiness out of just that family. And that guy, I remember him telling me we're hanging out. He's like, yeah, you get the good piece of meat, man. You got me in this house. I started laughing and be like, you're too much. And I remember him telling me, hey, when I was leaving, he shook my hand and he held it. Right when I shook his hand, he held it just an extra second longer. And he looked at me. He's like, hey, thank you. And that was just chills, man. It was the coolest thing ever.
Awesome story, and glad you shared it because, I said it again. It's just cool, man. It's good when you do right for good people and you can make their life better by just doing your job. I think that's what you're passionate about. Me too. I know Blake is. We all 3 sit in awesome positions to help people be better, financially equipped, more successful, whatever the case might be. And we just have to show them kind of that vision and that line and just care, just want to help people kind of cross over that finish line. So I think an awesome place to end this conversation, man, is let's jump into some money, what you would consider, if you would look back 10 years and you said, had to talk to younger Jamie, what were some money moves? Hey, I'm glad we did this. And, that you might tell kind of our generation out there that, might need some direction in real estate. Just, I loved what you said at the jump. That's a money move. Know your budget, know living within your means.
Huge.
That is the hardest thing in my entire job for all listeners out there as a financial planner, is getting somebody to sit down and go over their income and expenses. No one wants to look at it. No one knows what the hell's going on with it.
Out of sight, out of mind, Sean.
It's the only place you have to start. It's like, we have to figure out where your money's going, and no one wants to do it. So we'll do a whole episode on budgeting. It's going to happen. It's got to happen.
Oh, yeah.
So,
Light bulb.
Jamie, kicking it to you though, buddy. Just hit us with some money moves that you feel like you got to shout out there for us.
Yeah, definitely. If I would have talked to young Jamie, I would have told him, don't buy that really nice Mercedes Benz.
Yes. Car payments
you
are
were
the
moving
worst.
around.
Don't do car payments.
Yes.
Big car payments, screw you.
That will kill your purchase. They call it purchasing power, how much you can afford on a home. So if I were to talk to young Jamie again, I would have been like, hey, stick with your busted up, souped up V6 Mustang that you got, and tough it out and ride it till the wheels fall off. That's what I would have told myself. I did listen to myself when I said, live within your means. I did do that. But the car payment thing, I can't stress that enough. I just got dumb lucky because the mortgage was just so low. My car payment at the time, I think, was $300 a month. And I thought that was highway robbery. But the car payments I see on people today, 4 or 5 times, I saw a $2,000 a month car payment. I go, what do you drive, a tank? It was $2,000 a month. I was like, what are you doing? I remember
It's not worth it.
It's not. If you're asking me, a little page of just stay lean as you possibly can. That's what I would have told myself too. Stay lean. What I mean by staying lean is saving up your money, investing it with somebody that's super knowledgeable like Sean, and that can tell you how to invest that money. I would have invested money sooner. I think I would have done that way earlier in my life if someone had just gave me a little bit more guidance on that. And I learned so much out of just being around in the banking industry. I learned so much by just hanging around with these top dogs and seeing how these guys didn't have car payments. They all lived within their means. I found out right away. Yeah, you get 1 or 2 that, they like to think that
Little
they're
flex.
Yeah, Leonardo DiCaprio and the Wolf of Wall Street, right? But then you also had some people that were just, I'll never forget this one. A client of mine, he used to always come into the bank and he had overalls, he had dreads, he always looked dirty. But every time I did a withdrawal for him for $100, he had a little north of $2 million in his account.
Wow.
And I used to be like, wow, don't judge a book by its cover. I used to look at him and people would make looks at him and I would be like, no, you wouldn't even know it. That guy has more money than you would ever think in your life. And so I would tell myself as a solid pro tip, stack your cheddar, stack up your money, save up as much as you can, get yourself prepared. Don't get yourself into high debts. Don't do that. Don't try to keep up with the Joneses. Keep those payments down. And then 3, I would say partnering is not a bad idea. We do a lot of investor loans too. As long as you have it down in writing, I think you always put yourself in a winning position and you'll speak clearly, because a lot of people have this idea of like, oh, let's get a house together and let's figure it out. But they really don't figure out the logistics of it. And that's where you want to have someone like myself that could say, hey, wouldn't it be a bad idea to think about this and this if you guys are going to do this together? And then I would have told myself to buy more homes. That's what I would have told myself. I would have told myself, buy more, Jamie. You're doing good. In I want to say right around 2017 or 2018, I had 3 homes. I had 3 homes under my name. And by law, when you buy a home, there's something called an intended occupancy. So that means that you're signing something at the closing saying that you intend to occupy this property as your primary, meaning that's where you're going to go home to rest your head at night. And you have to stay in that property for at least 1 year and a day. Okay, that's the intended occupancy. After a year and a day, you can go buy another property if you can afford it. And so what I would have told myself is every year and a half, every 18 months, check where your finances are at, seeing if the property you can rent it out so you can go out there and buy another property, and saving up in that 18-month time frame just so you can get yourself another home. Doesn't have to be a bigger home necessarily. I know people that have 50 doors, they own 50 homes, and all of them are all in the sub 400 range on a purchase price. So you don't have to go buy $1 million. He could sell all of them and buy $1 million property, but he chooses not to. He definitely picked a more, his route was, okay, more people can afford $400,000, $300,000 homes. Not many people can afford to rent out a $1 million property or $850,000 property. There's a demographic for it, sure. But will there be enough people to do it? And do you have enough time to cover those hard costs, is what they call them, your mortgage payments, your utility bill payments on that home while you're trying to get it rented? So there is a fine line of how you can plan and set yourself up for success. So definitely, if you're interested in wanting to do fix and flips, you want to do rental, you want to create your own rental property portfolio, Definitely. I've been around the block a couple of times. I've done it myself. I've done fix and flips. I currently hold 3 properties still to this day, working on the 4th now. And it's nice when you can put yourself in a position where now I feel like I have 50-year-old Jamie telling me what to do. And it's something that I wish I told myself when I was younger, like, hey, keep stacking up. You're doing great. And at the end of the day, comparison is a thief of joy. So don't compare yourself to someone else's progress. You stay in your lane, do the best that you possibly can, consult with professionals like Sean, Blake, myself, consult with us so we can guide you in that direction and tell you, hey, you're going right. You're doing great. I think that those are some pro tips to really take home.
That was beautiful, man. Well,
It really was. It was
what's
good.
up, dude?
Pretty
Yeah.
weird. I might put a teaser out there. We're gonna have you back because we didn't get into it, but I feel exponentially cooler when I say HELOC. But I want you to dive into how to take advantage of HELOCs. Well, what should people be wary of when they're dealing with mortgage brokers? Right? I'd love to get your insight on that on another episode. But
Love that.
Jamie, man, you're a true professional. We appreciated it.
Thank you.
You're the man.
Yeah, brother. Thank you so much for coming on. Learned a lot from you. And yeah, dude, just thank you for being the gentleman that you are and the family man that you are. Yeah, blessed to know you, buddy. So thanks for all the insight. Thanks for coming on, Blake. Good to see you, buddy. Have a good weekend.
Always. And real quick, just to end it off for Jamie's time. Jamie, how does someone find you? Is LinkedIn?
Thank you.
Oh,
Blake.
that's
Thank
solid.
you.
Oh, I love that. Thank you.
How does someone find you?
So shameless plug. Shameless plug. I'm gonna pull up my Instagram right now. Let me throw that in there real quick for everybody. My email is jf@niftylending.com.
You're gonna have to spell it Nifty.
Yep, Nifty spelled NYFTY, lending.com. And my Instagram handle is Jamie_MTG_advisor.
Follow the guy. He's got your back. We appreciate you, Jamie.
Thank you.
Later.
I appreciate you guys. Thank you so much. It's a blessing. Thank you guys for
Yes,
having me
sir.
on.
Absolutely, man. Thanks for coming on. See you guys.
Take care.